Good morning, and welcome to today's revenue recognition webcast. And we can tell by the significant number of people registered for today's webcast that there's a lot of interest in the standard, and we appreciate you joining us. Today's session is scheduled for 1 hour. In the first half of the hour, we'll provide an overview of the new standard. Then you'll be asked to select an industry breakout session, say around 10:30ish. The industry breakout sessions will use the second half of the hour to build upon the framework we'll cover, drawing on examples that are tailored to your relevant industry. The slides from this overview session are included in the resource folder of the viewing console. You'll also find an article there we released this year on the new revenue recognition standard that we hope you find useful. As for introductions, my name is Fred Frank, and I also have Allison Sellers with me, a senior manager. Good morning, Allison. We're both members of our firm's professional practice group. Allison and I will be taking you through the overview before diving into the industry breakout sessions. Our agenda today will include walking through the 5 steps of the new standard, discussing the effective dates, methods of transition, and the disclosure requirements. And if you have questions, please submit those questions via the Q&A window. We expect to have time at the end of the webcast for Q&A. So with that brief introduction, let's jump in and start. I'll start with a little background. As most of you know, the standard was issued in May of this year. This was the culmination of a project that was started all the way back in 2002, representing around 12 years of work, with most of the heavy lifting being done the last 6 years by the board. The standard is largely viewed as a successful convergence project with an almost completely converged standard for US GAAP and IFRS. The issued document itself, or ASU 2014-09, is over 700 pages. Over 700 pages long, but don't get too overwhelmed by the length of the document. It's really only about 150 pages of standard, and even that may sound a lot like a lot to you. However, it's not a bad deal considering that it replaces over about 800 pages in the FASB's codification, around 500 pages of the basis for conclusions. So it's not really that bad of a trade-off. The standard creates an entirely new topic in the codification, topic 606. And it's a new topic in the codification in part to emphasize that this is not a change or a modification of the existing guidance, but a complete replacement of today's existing revenue recognition guidance. Also, the document creates or moves guidance to other sections of the codification, such as ASC 340-40 for guidance on costs incurred to obtain or fulfill a contract. So don't be lulled into thinking that all you need to know is in topic 606. The current revenue recognition guidance of course, is included in topic 605, and when the new topic 606 is turned on or effective, the old guidance will be sunset and completely superseded. For example, the new guidance will replace industry-specific guidance, such as the accounting for software arrangements, percentage of completion, and sales of real estate. We will also no longer look to the current multiple element guidance regarding allocating revenue to those elements that have a standalone value. That being said, even though the current literature is being replaced, we may find that we'll end up with a similar pattern, or perhaps the same pattern of revenue recognition, but the journey we'll take to arrive at that answer will be different. So the new standard, for the first time as far as US GAAP is concerned, includes a principle related to revenue recognition. And you can see it on the screen. The principle is recognize revenue to depict the transfer of promised goods or services to customers via contracts in an amount that reflects the consideration to which an entity expects to be entitled to those goods or services. And as we walk through the 5 steps today, you'll see that the steps are grounded in this principle. You'll also note that the principle does not refer to the completion of an earnings process, the matching of revenues and expenses, or explicit references to risks and rewards or transfer of title, which is not to say that these elements are not relevant in the model or should be completely ignored. They're just not part of the principle. The standard also applies to nearly every industry and entity. The scope is, as you might expect, includes those contracts with customers for ordinary sale of goods or services. Notice the focus on contracts with customers. A contract is an agreement between two or more parties that creates enforceable rights. And those contracts can be written, oral, or implied by your customary business practices within the standard. So they don't necessarily have to be in writing. They can be oral or implied by customary business practices. What's out of scope are leases, financial instruments, insurance, essentially certain specialty areas that are covered in other accounting literature that are not part of the scope of this guidance. Moving into the effective dates, the standard is effective and required to be applied by public entities for interim and annual periods beginning after December 15, 2016, so 2017. And there's no option for public entities to apply the standard before that time. Non-public entities get one more year to apply the standard, and the effective date is only applicable to annual periods. In other words, in the year of adoption, non-public entities' interim financial statements would not have to reflect the application of the new standard. Also, non-public entities may apply the standard as early using the public entity effective date. In establishing the effective date, the standard defines public entity as a public business entity, which is aligned with the FASB's definition of a public business entity, which includes the traditional SEC issuers as well as other financial statements filed with the Securities and Exchange Commission. It also includes a not-for-profit entity that is issued or is a conduit bond obligor for securities that are traded, listed, or quoted on exchanges or with counter markets, and then an employee benefit plan that files or furnishes financial statements to the SEC. So the definition is quite broad, and it could actually sneak up on some companies or some entities that don't think of themselves as public entities. For example, if you're a non-public entity that is acquired by a public company after the effective date for public entities, but before the standard is effective for non-public entities, and your financial statements are filed with the SEC because the acquisition is significant, based on this standard, you would be required to comply with the public entity effective date. And so this has potential to catch some companies off guard, so to speak. And that takes us to our first polling question, which is, just to get your view, do you believe there is enough time to adequately prepare for the standard's current effective dates? So yes, no, not sure, or not applicable. And while you're answering that, I'll ask Allison a question. You know, the boards have provided a long runway in terms of timing for companies to apply the standard. You know, what have the boards done to obtain input as companies work to implement the new standard?
Well, Fred, since this is such a significant change and completely revising all existing revenue recognition guidance, the boards have formed the Joint Transition Resource Group for Revenue Recognition. So this is a joint board with the International Accounting Standards and the Financial Accounting Standards, and they are going to be a sounding board of potential implementation issues that could arise as companies and organizations look to implement the new standard. It also is providing learning opportunities and a resource for entities to look at how other entities are applying and other problems entities have come across when they're looking to adopt the new standard. They will not be issuing any guidance, so it's not a new regulatory body, and so there's not going to be any information in that regards to them. They're really just a sounding board to let FASB and the ASB know if there's issues companies are coming across as they're looking to implement.
All right, so it's a sounding board. You know, and at the last meeting, they've had two meetings so far in July and October. They actually had their last meeting on Halloween, October 31st, and Jim Croker, the vice chairman of the FASB, indicated that the FASB exploring whether to propose delaying the standard's effective date. And Mr. Croker said that the FASB will decide to do whether to do so in early in the second quarter of 2015, so early next year. Having said that, I want to get your hopes up or delay your implementation project. The FASB is getting mixed feedback, and there are some that think it's a good idea. There's some that are objecting to it. Also, the tenor of some of the requests to delay received by the FASB may be due to the fact that companies haven't starting to implement the standard, or they're behind, which is probably not a persuasive argument for the delay. All right. Move on to the poll here. So overwhelmingly, we all think there's enough time. That's excellent. And we got some that are not sure. Next, I'm going to move into the transition, and perhaps we should ask the question after we talked about transition. So the standard provides two methods for transition: a full retrospective approach with some optional practical expedients, and then a modified retrospective approach. A full retrospective approach is, as it sounds, an entity would reflect the new guidance in all periods presented in the financial statements in the year of adoption, including those prior to the effective date. Now, the FASB provided practical expedients to simplify your life when applying the new standard. For example, the first one on the list would not have you apply the new standards to those contracts that begin and end in the same annual reporting period. And this is a really significant simplification for, say, public entities that report quarterly financial information, because the practical expedience is focused on the annual period and not the interim periods. Also, for many industries, it's very common to have contracts that begin and end in the same annual period. Therefore, this is a good deal. The other option is the modified retrospective transition method. And entities using that method, entities will apply the standard to only those contracts that have not yet been completed at the date of adoption, or said in another way, this method will only apply to open contracts. And then upon adoption, entities will recognize the cumulative effect of the initial adoption as an adjustment to the opening balances of retained earnings. So there will be no changes to the prior period financial statements at the date of adoption. And this may seem like a great option for some, but it's not without some complexity. For example, the disclosures required under this transition method will require disclosing the effects of adoption on each financial statement line item in the year of adoption. This would essentially mean that you would have to keep two sets of books in the year of adoption, one under the new standard and one under the old standard. Next, we'll move forward and get into the five-step process.
Thanks, Fred. So I'm going to walk you through steps 1 through 4, and Fred will jump back in with the final step in step 5. So for the initial step, we will identify the contract. And a contract is an agreement that creates enforceable rights and obligation. And it's important to note that enforceable rights and obligation is a matter of law, so it determines in what jurisdiction you're in and kind of what are your normal business practices as to whether or not you have an enforceable contract. There are 4 criteria of this contract. It has to provide the approval and commitment of both parties, so the seller and the buyer have to agree to the contract and also have approval of it. The identification of the rights and payment terms, so the rights of the seller and the buyer need to be identified in the contract and what the payment is going to be. Also, is there commercial substance to the contract? So the risk, timing, or amount of the entity's future cash flows is expected to change. So there's going to be some exchange as a result of this contract. And also the collectability is probable at inception. So are there future events that are likely to occur that will allow you to receive the money? This really isn't a consideration of the credit risk so much as just the customer's ability and intent to pay. There is a caveat for identifying the contracts. It is possible that if you have multiple contracts that are very similar, that you can group the contracts. And so this is a practical expedient. If a company elects to use this practical expedient, it will need to be included in their financial statement disclosures. But this could be a benefit to companies that have a high volume of contracts, such as telecom industries, where you have various potential configurations, but you have multiple goods and services, but they're all very similar. Because implementing into an accounting system the standalone selling price for each good or service within this type of industry would be very cumbersome and there wouldn't be the benefit to it. So there are some industries, if you have a high volume of very similar contracts, you may be able to group your contracts. Now for the next step. So after we have identified the contract, the step 2 is to identify performance obligations. And the performance obligation is the good or service you're expected to provide as a result of this contract. Now, the criteria to determine what a performance obligation is whether or not you have a distinct good or service within that contract. There are 2 criteria in regards to determining whether or not it's distinct. A customer can benefit from the good or service on its own or together with other resources that are readily available, and the entity's promise to transfer the good or services to the customer is separately identifiable from the other promises in the contract. This second criteria is a new concept in this standard. So to conclude on this one, so basically the good or service is distinct if it benefits the customer on its own. So basically if this good or service can stand alone, it isn't used to create a combined output. An example of a combined output would be a construction contract to build an office building, as that would likely be treated as one distinct performance obligation, even though there are many inputs and unique services and goods that are performed, such as demolition, foundation, framing, and finish work. So while each phase of the construction project may be a separate component, it's intended to produce a combined output such as the building. If it doesn't significantly modify another good or service within the contract, so that would be some sort of customization. Maybe that's if you got a software license and there was also some customization of that license, that would likely be considered one performance obligation. So there's many criteria that you'll look at to identify separate performance obligations. After determining how many performance obligations you have, you're going to look at the overall transaction price, and this is step 3. Within here, you're going to consider what amount the entity expects to be entitled to receive. So this is different than the contract price. The transaction price may be equal to the amount stated in the contract, but it could be different because it clarifies into what you are expecting to receive. Some areas that could impact your transaction price are variable considerations, price concessions, any related constraints. So if you feel that maybe there's some areas that you can't control that's going to impact how much variable consideration you're going to receive, you may not be able to recognize that revenue at the front of the contract. If it's right of return, and also non-cash considerations need to be considered. You have to determine what is the fair value of that non-cash to include in your transaction price. On this slide, we have a couple of examples of variable consideration. It could be a performance bonus, some claims, or liquidated damages. And you would estimate the variable consideration using the best method that predicts the amount of consideration expected to be received. 2 methods addressed in the standard are the most likely amount and the expected value. The most likely amount is the single most likely amount in a range of possible considerations, versus the expected value is a probability-weighted amount of a range of possible outcomes. Having these 2 methods to determine the variable consideration could be a significant change in many industries, as now there may be amounts that you would defer as you weren't likely to earn that revenue till the end of the contract under the current standard. Under the new standard, you would include some of this consideration in the beginning of the contract under this new methodology. So I've briefly mentioned constraints on variable consideration. There may be some areas that you would not fully recognize all the variable consideration that you expect to receive during the contract, as there may be some events that are outside of your control that may restrict the amount of variable consideration to be included. First, you want to make your estimate of variable consideration, and then you're going to evaluate any possible constraints that would result in restrictions in revenues. You don't want to recognize this revenue up front if there's a concern about this constraint, as it would result in a revenue reversal. So the FASB was wanting to avoid significant fluctuations in your revenues, and they introduced this idea of a constraint. Another piece in determining the transaction price is significant financing component. The financing agreements can be implicit or explicit in the contract. You would consider the significant financing component if it was significant to the overall contract and if the payment and the transfer goods or services extended for a period of more than 1 year. So if you transfer the good or service to them and then they weren't able to pay you for 18 months, you may have a significant financing component that you need to consider. In that case, you would have to adjust the transaction price for the time value of money and the timing of payments. The interest rate you would be used in this transaction would be if you were entering into a separate financing transaction with that buyer, you would consider their credit risk in determining your interest rate used in determining this calculation. So lastly, after we've identified our contract, we've looked at our performance obligations, we have our transaction price, now we need to allocate the transaction price. Of course, if there's only one performance obligation, that's really easy. You match that to the transaction price and you're done. But if you have a contract with multiple performance obligations, you have to allocate the overall transaction price to each performance obligation identified in the contract. For multiple performance obligations, for example, one contract is signed with a customer to construct an office building and also construct a small parking structure near the office building. The office building and the parking structure will be two separate structures. They don't connect and they're not integrated in any other way. The office building and parking structure may be considered two distinct performance obligations, as the customer can benefit from each individually, and the customer could hypothetically select a different contractor to build either structure without significantly affecting the other structure. Under this scenario, the transaction price specified in the contract would have to be allocated to each performance obligation, the building and the parking structure, based on their relative standalone selling prices. So how do you estimate the relative standalone selling price? The standalone selling price is the price that an entity would sell a good or service to. So you don't have to have already sold this item at this price. You just have to be able to demonstrate that this is the price the buyer would be willing to pay in the current market. You could identify this through competitors' sales that you've seen in the market. So it's not as high of a standard as we currently have in determining what is that selling price that you would identify. There's also methods to estimate that selling price, which are outlined in the standard. So you may need to go through some of the details of the standards to determine the best way to estimate the standalone selling price.
So no more VSOE studies.
No more VSOE studies, which will be huge.
Yeah. All right, so that takes us through the 4 steps. Now that we've allocated the transaction price to each performance obligation, we have to now decide when to recognize the revenue allocated to those performance obligations. And the principle in the standard states that a performance obligation is satisfied when control over a good or service is transferred to the customer. So it's focused on control, and control is defined as the ability of the customer to direct the use of the asset and obtain substantially all the benefits from it. And control may pass at a point in time or it may pass over time. Note the focus here is on the transfer of control to the customer and not on the transfer of the risks and rewards of ownership or completion of the earnings process as we think of it today. And those small differences can have a big effect on recognition as you work through the model. Now I'm advancing the slide because it appears that we have the slides a little backwards, and I cover overtime first because the accounting model is built so that you consider whether revenue should be recognized overtime first, and then if it doesn't meet the requirements to recognize revenue overtime, you have to determine which point in time control transfers. Also, to recognize revenue overtime, only one of the criteria need to be met. The first thing to consider is whether a customer simultaneously receives and consumes the benefits as the goods and or services are provided. So this is really intended to capture traditional service arrangements such as daily security or cleaning services or lawn services. So what you're looking for here are situations where the customer benefits as the performance obligation is satisfied. The second thing to consider is whether the entity's performance criteria or performance creates or enhances an asset that the customer controls. An example of this type of arrangement is a construction type arrangement where you're building a large asset like a house on a customer's piece of land. And the third one, revenue is recognized over time when the entity's performance doesn't create an asset with an alternative use and the entity has an enforceable right to payment for performance to date. So it's very important that you meet both of these criteria in order to recognize revenue over time. And this is something new, and it's fairly complicated, and there's a fair amount of discussion in the new standard on these criteria. I've got to go back. Points of time. And the board has provided indicators when control has transferred at a point in time. So as you can see on the slide, the indicators include what's on the slide, but it's not meant to be a checklist type of approach. You can meet any one of them. So risk and rewards is in the list here, but it doesn't carry any more weight than any of the other indicators, though that's the familiar territory for us. All right, moving into disclosures. The standard requires a lot of disclosures. This disclosure objective is principles-based, which is to allow users to understand the nature, amount, timing, and uncertainty of revenues and cash flows from customer contracts, but the objective is met with a lot of required disclosures. So even if you believe the standard will not have a significant impact on the timing of your revenue recognition, the standard will have an impact on the nature and extent of disclosures related to revenue included in your financial statements. So as I flip through these slides, you can see there are a lot of required disclosures. Today, there are very few required disclosures around revenue recognition. And the boards, as well as regulators, have held for some time that disclosures related to revenue have been inadequate, and therefore we have new requirements. It's important that you review the disclosure requirements, and as you work on your implementation project, it'll be important that you focus on the required disclosures to ensure your information systems, your processes, your controls are designed to capture the required information to be able to provide those disclosures. So that takes us to the final polling question. What is your biggest concern regarding the adoption of the new standard? The effects on my company's reported revenues, the extensive disclosure requirements I just talked about, operational challenges, potential tax implications that we haven't talked about today, or none of the above. So we'll just give you a minute or a few seconds here to answer that poll. Get your answer recorded and get your CPE credit. As we're going to close. So it looks like there's a lot of concerns about just about everything, which is to be expected, as it's new and there's a lot to learn. All right, that takes us to the half of the hour. I'd like to thank everyone for attending the first half of today's session. At this point, please select your industry breakout session from the red widget at the bottom left-hand side of the screen. Once you make that selection, you can close this browser window once you're into that industry breakout session. Again, please select your industry breakout session from the red widget. There's a red folder at the bottom left-hand side of the screen. And then once you do that, you'll want to close this window once you join that session. And so, with that, I thanks again, and I'd say enjoy the rest of the program today.
Hello, everyone, and thank you for joining the Construction Breakout. My name is Aaron Falk. I'll be presenting today with Chris Gwain. A couple of housekeeping items before we get started. We're scheduled to complete this call at 11 a.m. We will be taking questions from the audience, and we'll save those for the end of the presentation. It's likely that presentation will extend, or the question and answer phase of the presentation will extend beyond 11 o'clock. If you need to drop off, we want to be respectful of your time. You'll still get CPE credit as long as you remain on the line through the 11 o'clock window and you answer the polling questions. So with that, let's get started. Again, my name is Aaron Falk. I'm a partner in the Puget Sound region. I spend the majority of my working time on construction contractors and real estate organizations. I also lead the firm's assurance committee for construction and real estate. When I'm not giving exciting webinars like this or working with my contractor clients, I enjoy coaching my kids' sports teams and working around the house. So with that, Chris, I'll throw the ball to you.
Thanks, Aaron. As Aaron mentioned, I'm Chris Gwain. I'm from the Orange County office. I practice in the construction space, and I'm heavily involved in the CFMA and AGC as well. So since we're strapped for time, let's get moving right along into the agenda. Today we're going to talk about, we're going to go through the 5-step process with some construction-specific examples, and then we're going to hone in on a couple nuances that we see here that we feel are going to impact the construction industry's financial statements. And then we'll have a brief Q&A session at the end of the presentation. So first, I thought it would be good to have a good polling question to get a feel for the audience, to see where everyone's at with respect to the new revenue recognition rules. You know, these things have morphed over time based on all the comments that the CFMA, AGC, public accounting firms that specialize in the construction industry have helped to kind of shape the final regulations that they've kind of come out. Now, originally, there was concern that there was going to be a completed contract method of accounting, and I think we've gotten to a much more happy medium where I think construction contractors will be happy with how the rules have kind of shaken out for the most part. So for the polling question, let's see the results. All right, that's kind of what I expected to see as far as the results, and seems like that's where most of my clients and prospects that I've seen out in the marketplace are at, looking to get more information about the new revenue recognition rules. So I know in the general session you guys went through the 5-step process. Here it is. Again, we're not going to dive too deeply into what each of the key issues are in the 5-step process. What we are going to do is go through some examples for some of the issues that we think are going to impact construction clients in some of these areas. I'm just going to skip over the first step, identifying the contract exists, because I think for most contractors that's going to be the same as in the old guidance, and I wanted to kind of focus in on some of the other areas. So step 2 in the 5-step process, determining performance obligations. Let's jump into an example here. In this example, let's assume a company is contracted to rebuild a warehouse, including performing these following services to ultimately rebuild the warehouse. How would we go about determining the number of performance obligations in a situation like this? Well, the answer is 1 in this situation, and this was something that was really heavily debated, and I think one of the areas that contractors were a little uneasy about was they have to split up their contract into all those different components: demolition, framing, plumbing installation, electrical installation, or would they be able to keep everything under one contract in their WIP schedule? I think since they were able to come to a happy medium, since at the end of the day there's one distinct performance obligation and one highly interrelated service being performed, which is rebuilding the warehouse in this example. So I think that was a really good thing from a construction standpoint, so we don't have to go about continuing to do multiple contracts on the WIP schedule. Step 3, determining the transaction price. Again, this was brought up earlier, the transaction price is the amount of consideration which an entity expects to be entitled in exchange for transferring goods or services. Some of the complex areas that are going to impact construction clients: variable consideration and the related constraints, and non-cash consideration. Non-cash consideration, primarily those are going to be valued at fair value, but I thought it would be good to kind of go into some variable consideration examples. Now, if you recall, variable consideration under the old guidance was primarily looked at under the gain and loss contingencies. If you remember the loss contingencies under the old codification, you'd estimate the loss contingencies when that loss contingency was estimatable and probable. And under a gain contingency, you'd recognize that revenue when it's realizable, and a lot of times when it was actually collected. And so I think determining that transaction price is now all centralized in this revenue recognition standard. So that'll be a little bit different from where it was located on the old prior codification. So some examples for construction clients of variable consideration that I'm sure most of you have in your contracts: performance bonuses, claims, liquidated damages. How do you go about estimating them, and when do you go about estimating them? Well, I think the challenge is going to be most of this estimation will all be done at the inception of the contract. And so I think what you're going to see is in a lot of cases, this is going to mean accelerated revenue situations for a lot of contractors. Just because if you think about it, when you're reflecting a performance bonus and you make that estimate if it's going to be included or not included, you're going to be doing that now initially, as opposed to under the old guidance when there was a gain contingency, that it wasn't until it was realizable at the end of the contract or when you met that circumstance. So that'll be an interesting situation, and you'll need to make sure you're documenting that for your auditors when they come in and look at your file. So how do you go about estimating this transaction price? There's two ways to go about it. There's the most likely amount, which would be utilized when there's a binary result, an all or nothing situation. Most likely in a performance bonus situation where you have a set date, and if you meet it or you don't meet it, it's going to happen. The expected value method for estimation will be utilized more so when there's a range of potential outcomes. So, for instance, most contractors have clauses with liquidated damages. It could happen in 10 days, 15 days, 20 days. You're estimating that a long time in advance before those days actually occur. And so going through that estimation process, you'll probably be utilizing the expected value method when estimating liquidated damages.
So, Chris, one of the areas that we would expect to see an expected value approach could be in the heavy highway space, where we have contractors that have provisions in their contracts where they may receive bonuses based on the number of days that they complete early. So say they get $10,000 a day they complete early, and then on the back end they have liquidated damages for contracts for each day that they finish late. We would expect contractors under this new guidance to take a look at the probability of their completion dates and then weight that probability to arrive at a total contract value.
Right. I think it's going to be an interesting thing for contractors, and I think they're going to need to utilize things such as their customer relationships and their history and past business practices and how they've been able to do meeting those liquidated damages clauses in their contracts and performance bonuses clauses in their contracts. Because again, a lot of this estimating is going to be done at inception of the contract.
That's right, Chris. And from an audit perspective, and a financial statement perspective, there'll be challenges from the auditors as well, getting comfortable with the estimates that are included in that contract value estimation, because it will have a translation to revenue recognition earlier in this type of setting than it does under current GAAP. Right.
And then after you go about estimating the variable consideration, we need to kind of look at the constraints, right? So what would keep a contractor from recognizing a ridiculously large amount of variable consideration? In the next slide here, you see that you can only recognize revenue to the extent it's probable that a significant revenue reversal won't occur. And so what does probable mean? It means future events are likely to occur. In most practices, that means at least a 70 to 80% likelihood that it would occur. And so, again, I think this will be a huge area where when your auditors come in at the end of the year to look at your financial statements, that you want to make sure that you've documented how you got comfortable that you've met that at least that 70 to 80% likelihood that transaction would occur. So I thought a real good way to kind of show this determination of transaction price would be to set up an example. So here's an example here on the next slide. We have a $10 million fixed price contract to construct an office building. The contractor would receive a $500,000 performance bonus if it's completed by January 1st, 2018. And the company determined that it's likely that it will be complete, 80% likely that it will be complete by January 1st, 2018. So what would the transaction price be in this example? Well, since the contractor determined that it was probable that it would occur, and since it would it'd be over 80% likelihood in our example, the full $10.5 million of estimated contract value would be included in that contract value at inception. And that's assuming, again, in that example, we use the most likely amount approach, since the result would be binary, one or the other. And so that's a kind of pretty basic example, but again, I think the difference here is that it would be done at inception as opposed to when that performance bonus was met at the end of the contract.
Chris, in this example, we used the 80% probability. When we get to the authoritative guidance, that probability isn't necessarily defined, so what reaches the level of probable. I think most guidance that I've seen and most interpretations I've seen, it starts at a level of roughly around 70% and above. Is that consistent with your understanding?
Yeah, Aaron, that's consistent with what I've seen in practice between that 70 and 80% threshold. And now Aaron's going to jump in here into step 4, allocating the transaction price.
Thanks, Chris. So step 4 for contractors is, and for all folks, is allocating the transaction price. And when we look at that we've identified the performance obligations, and then we're looking at, okay, how do we allocate that price to each of the performance obligations? The easiest route, obviously, would be, and what the standards require would be that we would allocate that price if we have a standalone basis for doing so. So if we have consistent services that we deliver and sell at a standard price, we would use that to allocate it. In the contractor space, oftentimes the price is dependent on each individual contract. So if we've got multiple performance obligations, we need to apply that thought process to each one of the obligations. And so we need to go through and say, all right, we've got a separate performance obligation here. What's the right way to value that piece of our contract? If we've got a single performance obligation, it's fairly straightforward. So let's talk a little bit more about that. There's 3 approaches. If we don't have a standard pricing for our performance obligations, i.e. if we're not selling it, same price each time we perform the service, we've got 3 methods that the guidance would prescribe to be used. The first 2 methods are the top-down approach and the bottom-up approach. Both of those methods, and we'll talk about those a little bit more, are the methods that we would expect contractors to use first in their assessment. The residual value approach is one that is used kind of as a default approach if you can't use one of the other approaches, and that really comes into play when you've got maybe a performance obligation that is very difficult to measure the value of that in the marketplace. It's very hard to estimate what it would be worth, but if you have 2 other pieces of the contract, so let's say we've got a contract with 3 performance obligations, 2 of them we can measure. The third then would be the residual value. So the third that's difficult to measure would get the remaining value of that contract allocation. The top-down approach. Go ahead, Chris.
Oh, Aaron, I was going to say, it seems like in the construction practice, the bottom-up approach should be utilized pretty typically just based on the inherent nature of the estimating that's done when a contractor goes out to bid a job, at the inception of the contract.
Chris, I think that's a great point. Oftentimes, the contractors have a margin that they're targeting, and so when they're estimating, they're looking at, here's the cost we think we're going to spend to perform this contract, and then we use that bottom-up approach, as you indicated, to say, okay, cost is going to be $1 million, we want to make a 10% margin, so the pricing on that or the value of that element of the contract is $1.1 million. The top-down approach differs from that by looking more at a market participant perspective and saying, okay, if we have an idea of what the market would value that performance obligation at, we would use that approach. Like you said, Chris, I think in this space we would expect the majority of our contractors to use a bottom-up approach. So once we've allocated the contract price to the performance obligations, we get to the 5th step, which is where we want to get to, and that's recognition of revenue. So this is the 5th step of the revenue recognition model as it's been issued. Currently, and in this guidance as well, there's effectively 2 methods that contractors are going to use for revenue recognition. One is at a point in time. That translates to what's currently being done as a completed contract or as the item is shipped. The second one is a percentage of completion or overtime type methodology. So let's explore that just a little bit more. Revenue is recognized over time, so that percent complete type concept, if one of the 3 criteria is met. on this slide. And the criteria that we expect to be met most frequently is the third criteria for contractors, where the entity's performance, installation of wiring, roofing, those type of things, doesn't create an alternative asset that the entity could go out and sell. So if I'm installing wiring in a building, I can't go sell that wiring installation to somebody else that doesn't own the building. And so we would expect most contractors would qualify for the percentage of completion if they are currently, if they're currently meeting the revenue recognition standards for percent complete. We would expect that they would hit number 3, and we would continue to do it under the current revenue recognition model that's being presented here.
Aaron, I think it's important to note that, percentage of completion under SOP 81.1 is gone, non-existent technically. Now it's called, progress over time. So the terminology is a little different. So I do think, just pointing out that, the old percentage of completion under SOP 81.1 is no longer in existence.
Chris, I think that's an excellent distinction. The nomenclature has definitely changed. The mechanics will, as you'll see here in a little bit as well, are going to be a bit different, but the majority of contractors are going to see that the revenue recognition over time will continue for them, is our expectation as they move forward. When we look at measuring of progress, so there's 2 methods for measuring progress. One is an output method, and those are things like units produced, appraisal of results, hitting milestones, those type of things, surveys of performance, sometimes in government-type contracting. Then there's the input methods, and this is what we see most often in practice, is input methods related to cost measurements, costs incurred, labor expended sometimes, but oftentimes we see contractors using the cost-to-cost methodology. So let's go over an example of cost-to-cost type methodology. Our example here, we have a 2-year contract. It's $20 million to rebuild a warehouse. There's only one distinct performance obligation. We're expecting $16 million in total estimated cost. $4 million are incurred. Contractor does not own the land or warehouse, and the contractor determined the cost method are the best measure of progress. So the question here, our second polling question, would be how much revenue should be recognized at the measurement date? Give everybody just a quick moment here to answer the polling question, and we will then move on to see our polling results. So we had a mix of responses here. We had some folks that were responding at $4 million and others that were responding at $5 million. So under this example, the correct answer is $5 million. And so using the percent complete, we are 25% complete on a $20 million contract.
Yeah, I think it's important here to kind of note, while the result is pretty consistent with the old percentage completion guidance that was in the old SOP 81.1, I do think it's important to go through that 5-step process and make sure that there's no other nuances under the new standards, because this is just a very basic example. Going through the process and making sure that you're considering all the new components of the new revenue recognition model is important.
Great point, Chris. So again, the answer here, slide, is $5 million. Change orders. Let's talk a little bit about change orders. So there's 3 treatments under the new standard for change orders, and we'll talk about those just a little bit here. So there's the first of those would be a new separate contract, and that would be in a situation where the new services are distinct from the original contract. So kind of the thought process for me is that that's a new performance obligation, and that they're priced at standalone selling prices. The second option would be a termination of the existing contract replaced by a new contract, and that would be a fact pattern where the new services are distinct, but they're not at standalone prices, so it's difficult to estimate the price of that new performance obligation outside of the contract. And then the third option, which we think will be the most likely outcome for contractors, is the continuation of the existing contract. There's new services. They're not distinct to the contract. They're interrelated into the performance of the contract. So the new services would not necessarily create a new performance obligation, but rather new services within the original performance obligation. We think that this third item is very similar to the current accounting for change orders. Let's do an example on that. So if we have a 2-year, $20 million contract to rebuild a warehouse, we estimate that we'll have total estimated cost of $10 million. We've got one distinct performance obligation, and we receive a change order, and it's a $2 million change order of expected costs. At the balance sheet date, we've got $4 million currently of costs incurred, and we've got a history of executing change orders with the customer resulting in at least a cost recovery. So it's probable we'll recover our costs at a minimum. So the question is, how much revenue should be earned under that fact pattern? I'll give everybody just a moment here to think through the answer to that question. All right, let's move to the answer here. So how much revenue should be recognized? The answer is $7.33 million, and the way that we would arrive at that conclusion is that we have $12 million of adjusted costs, so our estimated cost of $10 million plus the $2 million for a change order. Our new contract value would be $20 million plus the $2 million of adjusted revenue, or for the $2 million of cost recovery that we would expect here. Note again that we discussed that the contractor has a history of at least recovering their costs on this change order, so they've determined that it's probable the contract value would increase. So their percent complete then would be measured at $4 million divided by the now $12 million of estimated cost, or 33% complete, multiplied by the contract value, and that's how we would arrive at the revenue that would be recognized. Uninstalled materials. Chris, you want to take it from there?
Sure. Uninstalled materials, if you recall in the past under the old guidance, once you installed the materials on a particular job, that's when you reflected that cost for those materials in the percentage of completion calc, and that's ultimately what drove revenue recognition. Under the new guidance, since the costs that are not proportionate to the progress in satisfying a performance obligation should not be input into the method calculation, revenue recognized on uninstalled materials will only be equal to the cost. This kind of goes back to the premise of the new final regulations. Revenue should really only be recognized when there's a transfer of control to the customer or service to the customer. And so uninstalled materials, if they're not installed, that transfer of control really hasn't occurred yet. So that's kind of the theory behind the uninstalled material piece. I figured a good example, walking through an example of how it would work, probably makes the most sense.
Chris, before we jump into that example, just to highlight that this is a deviation from current revenue recognition for contractors when it comes to unique materials. So typically a contractor today, if they're ordering something unique and for a project, they're allowed under the guidance to recognize revenue on that project for that cost, or include that cost in their revenue calculation. And under this methodology, that material, until control had transferred, it would be excluded from the calculation.
Right. You'll see that there's only a piece equal to the cost, right, of that uninstalled materials that would be included. Essentially, the cost is going to be stripped out of your cost-to-cost method calculation and then added back in at that cost at the end of the calculation. And so we'll kind of walk through a quick example here to kind of show how that kind of works. Assume here we have a $13 million fixed price contract to construct a building, including an installation of elevators. Again, only one distinct performance obligation in this example. And assume there's a $10 million estimated cost, including $1 million for the elevator costs. At the end of the year, the elevators have been purchased for $1 million but are not installed. And at year end, $4 million have been incurred on this particular project. So how much revenue should be recognized at 12/31/2018 in this example? Well, the answer is $5 million. And so how you go about determining that is you strip out that $1 million from your contract cost to date in the numerator of your cost-to-cost percent complete calculation, and also the denominator in your total estimated costs to come up with your 33% complete in progress of completion on the job. And then you multiply that by the $12 million, the $13 million original contract price, minus the $1 million for the elevators that have not been installed. to come up with your $4 million of progress revenues. You add the $1 million back for the uninstalled materials to come up with your total revenue recognized, the $5 million in this example. So again, a little bit different than how it was previously done. So I thought it would be good to kind of walk through a basic example to kind of show how uninstalled materials were calculated. Another hot topic with contractors is mobilization. Again, we talked about this before. The new guidance really emphasizes that revenue should not be recognized until control has been transferred to the customer. And so obviously, mobilization, that cost of inputting things into the contract really shouldn't be included in the measurement of revenue. And so under the new guidance, if you stripped out that mobilization, the question is, where would it go? Well, under the new guidance now, mobilization costs should really be capitalized on the balance sheet and then amortized over the life of the contract and excluded from the progress to completion calculation, which was how it was done in the past. And a lot of times in the past, you ended up in that largely overbuilt situation. So, that'll be an interesting divergence from under the prior practice as well. So I think those two nuances will be important to kind of keep in mind when you're going through the financial statement aspect. Aaron, you want to take over looking at retainage?
Sure. Let's talk quickly about retainage. So a couple things here that I want to draw your attention to. In the general session, they talked a little bit about financing components and present valuing contract values. When we look at our retention or retainage items, those are for the protection of the customer, and so those would be specifically outside of the financing scope of the standard, and those would be valued at the retention amount. So those are carved out, would not be reduced to a present value from a financing perspective. They also would be considered not necessarily a receivable. Receivable is defined in the standard as a right to consideration that is unconditional. Since performance is required to receive that retention, it would then therefore be kind of pushed back into a contract-related asset rather than a receivable, as many folks present on their balance sheet today as a retention receivable. Let's also talk about, real quickly, warranties and loss contingencies. So loss contingencies, the standard is going to be very similar to what we do today, looking at the entire loss. As soon as it's identified, it should be recognized. That really is not going to be a deviation from the standard. It's interesting that was an area that has been discussed a fair amount by the standard setters, and they arrived at the conclusion that the loss contracts accruing at the date that is identified is appropriate and continues to be appropriate. The standard also talks about warranties, and there's multiple warranties here. The assurance type warranty, which is the third one in our slides here, is the warranty on workmanship and the standard warranty on from defect and things like that. That would continue to be accounted for under the loss contingency warranty guidance of ASC 460. The other two types of warranties would be considered performance obligations, and so those would be treated as you assess your contract value as a separate performance obligation, and you'd be looking to allocate some of your contract value to those performance obligations. All right, with that, we've concluded our detailed dive into some of the contract-specific or contractor-specific accounting issues for revenue recognition. We're going to move into our question and answer phase of our presentation. Just to make sure, those of you that might have joined us late, to get the CPE credit, what you needed to do was participate up through this point and answer the polling questions. We want to be respectful of everyone's time and understand that folks may need to drop off the call, but at the same level, we're going to continue on a little bit past the 11 o'clock deadline here to see if we can answer a few of the questions that we received from the audience as we were going through them. So let's move into the question phase of the show. One question here is as follows. It sounds like the old standard of recognizing revenue only to the extent of cost on certain change orders is gone. Is that correct under the new standard? So the question comes back to, when would we get to recognize revenue on certain change orders? And it comes down to a measurement of probability. So if the contractor is able to demonstrate and show that on change orders they have a history of receiving those change orders with margin on those, my read of the standard is that they would be eligible to recognize revenue on change orders if they reach the threshold of probability. Chris, any additional thoughts on that question?
Yeah, my guess is the question pertained to probably unapproved change orders, and so yeah, I'd agree with that statement. I think you want to look at your history with the customer. You want to look at the company's past practices and how they treat unapproved change orders and be consistent. But I think those two things absolutely would be critical in evaluating how much to recognize revenue related to those unpriced change orders.
I agree. Second question is, do you see a big change in the current method of percent complete as a result of this new standard on typical contractors? Will the cost-to-cost method stay as a practical matter? I guess the answer to that question is, from my perspective, is that it depends. We highlighted a couple of the areas when we get into mobilization and uninstalled materials where I think the new standard will create a different outcome for the contractor. I don't think they'd move away necessarily from the measurement of progress of revenue over the contract. But I do think that the answer and the calculation will be a bit different. So when we are excluding mobilization from the cost-to-cost measurement, that would reduce the percent complete, and so early on in the contract it would have the impact of deferring revenue, for instance. So I think there will be some different answers achieved, but I do expect most contractors will still use a cost-to-cost method. Chris, any thoughts on that?
No, just to echo what you said, I think it's important, not to kind of default that, for most contractors it's going to be very similar and that it's not going to really have a impact on your company. I think it's critical to walk through that 5-step process that was outlined in the general session and some of the examples that we went over earlier, and make sure that there's not any nuances that will impact how revenue is recognized for your particular company, because a broad statement like that is a very dangerous statement to make. Every contractor has different nuances in their contracts. So, I would say, over the course of the next year is a really critical time to kind of look at your contracts and evaluate how revenue might be recognized either A, differently, or B, how to go about looking at your contracts and evaluating if some of the terminology that you guys utilize in your contracts need to change so you can go back, so you can recognize revenue more consistently than that you previously have.
Okay, here's another question. Where can we get more information on the change in mobilization costs and how retainage will be reflected on the balance sheet if it's not a receivable? So this question is one that's a great question. I think that there's still a fair amount of guidance that we expect to come out from not just the FASB as they're having meetings on implementation, but also from some of the trade associations when we look at implementation guidance. I mean, from a practical matter, most of my clients and most of the contractors that we deal with at Moss Adams are privately held clients, and so their implementation of the standard likely will be a year following the public companies. And so from that perspective, we will get some guidance and we'll get to see what the public companies are doing related to reflecting retainage and clarifying some of the questions related to how this is really going to work. Chris, thoughts on that?
No, I think I think generally speaking, I think they will show up in the balance sheet. I think you talked about one of the examples, the retainage. I think that's just going to be called something differently. And from a classification standpoint, it might be more of a long-term asset as opposed to a current asset. And so I think when once you get closer down the path of looking at your contracts and how things are going to look on your financial statements, it will be important to talk to your bonding company, your bank, and make sure that they understand, hey, things are going to slightly change from a presentation standpoint on your financial statements while your operations really haven't changed at all. So I think that the communication piece between your CPA, your bonding company, and your bank will be, pretty important over the next couple of years.
I agree, Chris. Hey, so everybody, we've got several other questions that I think are good questions, but more specific to individual fact patterns. So at this point, I think we're going to conclude our webinar. If you submitted a question that hasn't been responded to here, we've got your contact information, and we'll reach out to you with responses. We appreciate everyone that's joined the call and look forward to helping with future calls as board guidance comes out. And as you have questions, if you want to reach out to either Chris or I, we'd be happy to try to help you with any additional questions you might have.